One of the most important insights that you'll ever have regarding how to trade financial markets is what I call adjusting the frequency of your charts. And that's not as technical as it may sound. It just means changing the time frame of your charts. So instead of looking at one particular time frame and saying I trade on the 15-minute time frame, you would instead look at a range of time frames at all times. And that's why we use a complete range of time frames that includes time frames that most traders do not normally ever look at. Now let me just show you a little bit of what I mean. If I remove the candles from this chart, I can now see just these moving averages, and these illustrate what would be the beginning and the end of a movement or a trend on this time frame. And I'm not saying that this is a trading method, but this is a way of illustrating that movement. So on this time frame, which happens to be the daily, you can see that the trend has been down, and especially during all of this time there would never be any entry to go long. There would never be any trades that are visible for going long, and even during this time frame this is a retracement or a correction in a downtrend. This is a retracement or a correction in a downtrend, and you would never be able to see any entry going long during that time. But of course, if you simply adjust the frequency of your charts and look at this price action in between these two vertical green lines, you will see that just by changing the frequency of your charts, there are huge, beautiful price movements that would be quite tradable on a different time frame. And on this time frame, you would only be buying during all of this time, but would there be any opportunity going short on an even shorter time frame during this period of time? So by going to the 1 hour, or if I go to an even shorter time frame such as the 15-minute, I can now see that there may even be multiple entries for going short during that time. But these would not be visible on the time frame where I was first looking at it, and these opportunities only become visible by adjusting the frequency of the charts. Whenever people are presented with a new insight that could revolutionize their results in trading, a large number of people will just look at it and kind of say, well, that's interesting, and then they'll just go back to what they were doing before and continue to struggle and have poor results in trading. Another group of people will look at the same thing and just say, well, trading is just a scam anyway, and there's no way that it could ever work. So let me just go keep trying to trade, by the way. And other people will look at a new insight and then discredit it and say, oh, that's too simple. Other people will look at the same thing and then say, I already knew that. And then they just go back to what they were doing before and continue to get poor results in their trading and never experience how their results could be totally revolutionized by actually looking at their charts and applying what they have learned. So in any endeavor in life, you'll find that a small group of people will take useful information and actually apply it. But the good thing is you get to choose which of those people you're going to be. Well, I have looked at the results of many professional fund managers that post their results on their websites, and if you look at the dates and the wins and losses, you can see that their trading method is pretty much hit and miss. And what tends to happen is that during these periods of time when the market is trending, all traders have good results. A lot of people can still mess up during those periods of time, but that's when any trading method works, because if you go short during that period of time, you're going to have a winning trade. And then when this period of time comes along, that's when people start losing, and trading methods fail, because trading methods that would fail as a result of a market going into consolidation isn't really a trading method, because that's all markets ever do is trend and then go into corrections and consolidations. So a trading method that works would obviously have to account for that. So most people look at a chart like this and they say, well, during this period of time the market was choppy and there wasn't any good trading opportunity. But if you just adjust the frequency of your charts, you'll see that there is an excellent opportunity at that time on a different time frame. And a good trading method would stop trading on this time frame right precisely at this point. And how would it know to do that? That this would be the point right where you would stop trading on this time frame. Then just adjust the frequency of your charts, that is, change time frames. This is the 4 hour. I'll go to the 1 hour. On the 1 hour, I still see the same choppy looking pattern, but I just see more detail of it. So if I adjust the frequency again and tune the frequency down to about the 15-minute time frame, examining the same period of time, I'll see that during that period of time there were excellent trending trading opportunities, again illustrated by the shape of the moving averages. You can see how there were surges that were tradable opportunities. Our trading method directed us to stop trading on the 4 hour time frame precisely at the beginning of this correction and to begin trading on this time frame, looking only for these entries to go long, which all have a specific criteria for entering each one of these movements up. Typically, when a trader looks at a chart, they choose to look at certain standard time frames, and they may use an indicator. And when it comes to indicators, you'll find that indicators tend to work some of the time, and some of the time they don't really work. And it's kind of like hit and miss. So you may look at an indicator and you notice that, well, it sort of works some of the time. But the reason that it doesn't work all of the time is because you must adjust the frequency of your charts for the particular move that's currently happening and be able to know in advance how to adjust the frequency of your chart so that you will see that signal on the right time frame. For instance, right here, this is the pound yen on the 1 hour time frame, and I have on here stochastics with a setting of 2188. Now you'll see that stochastics went into the extreme overbought zone and made a bearish reversal in the overbought zone right at the beginning of this uptrend. So that was not a good time to exit, and then it continued to oscillate up and down all throughout this entire trend. Now here's the same trend with another multiple setting indicator, and you'll see that this indicator went up into the extreme toward the beginning of this trend, oscillated up and down, crossing in both directions all throughout the trend. Very useless for giving you any kind of a signal to enter or exit a trade if you're wanting to exit at the end of this trend and get all of the profit. But simply by adjusting the time frame to the 3 hour time frame, you'll see that CCI made one cycle up, formed divergence, where CCI is going down, price is going up, and the lines compressed together and crossed our key level right exactly at the end of this trend, but only on this time frame. And how is it that we also knew in advance that we were looking at this time frame to see the signal? If you weren't adjusting the frequency of your charts and you weren't aware of how to do this, you would simply just be looking at constant hit and miss in trading. The time frame that you need to be looking at in trading is constantly shifting from one time frame to another, and there is a roadmap that tells you what time frame to focus on exactly at what time. Once we have the end of a trend on one time frame, we know that we're going to stop trading on that time frame right exactly at that point, and we're going to be trading on a different time frame, and there we're going to see the signals that we're looking for forming just the way they should form, except they would form on a different time frame, and that's where they would be visible. If you have a trading method that tells you to choose one time frame or two time frames, such as the 15-minute using the 1 hour as the long-term guide for entering and exiting trades on a shorter time frame, you simply cannot see the proper entries and exits that would give you the maximum amount of profit that's possible to get in trading.